Hi guys, and welcome to another week ahead video. Now in this week's video we're going to keep our focus on the US dollar, which has seen some massive price action moves in the last couple of sessions, mainly due to the coronavirus and the possible economic implications and what that'll cause the Fed to do next. So let's jump into this week's data to see exactly what we're focusing on for the dollar and see how we can possibly trade it in this upcoming week as well. Okay, then looking at the baseline for the US dollar now, the dollar had quite an exciting week this past week with US 10-year yields falling below the 1% level for the first time in its history, and also the Fed coming out with a surprise 50 basis point rate cut into meeting on Tuesday. Now, as a result of the fears of the possible economic fallout from the coronavirus, the markets were very aggressive pricing in additional rate cuts for the Fed, and this saw considerable weakness in the dollar index and saw the dollar lose ground against majority of the majors. Now, the big drop in the dollar occurred despite some positive economic data points in the form of ISM non-manufacturing as well as NFP. The ISM services PMI showed a decent jump higher despite the dismal drop we saw in the market services PMI 2 weeks back. And apart from the ISM, we also saw NFP coming in strong with a big beat of 273k jobs, which pointed to a continued strong pace of job growth in the US. Now, the strong pace of job growth continued in February, with employers adding 273 jobs and saw upwards revisions as well to the January's already decent numbers. Now, the lack of positive reaction from the dollar on the back of the positive data points showed that the market attention is firmly set on the coronavirus, as well as how the Fed is likely to respond to support the economy. Now, the dollar also failed to find any type of safe haven bids despite the fast escalation of the virus throughout the globe, and this was largely because the Fed's monetary policy has a lot more room to the downside compared to other central banks like the ECB as well as the BOJ. And as a result, as long as the market keeps up their aggressive rate cut expectations for the Fed, we do expect the dollar to remain pressured in the short term. Now, looking at the upcoming risk events and the baseline for them, the market's main focus for this week will remain on the coronavirus, as the virus is the main reason for the current aggressive rate cut expectations. As of Friday, after the range of Fed speakers that we had, the market is now pricing in 100% probability of a 50 basis point cut and a 26% probability of a 75 basis point cut at the Fed's March meeting. Now, even though ISM and NFP data failed to move the needle last week, we might see more reaction from the upcoming forward-looking sentiment-based indicators like the NFIB Small Business Optimism as well as the University of Michigan Sentiment Survey. Now, it's very likely that business as well as consumer sentiment deteriorated in February as the spread of the coronavirus accelerated globally and financial market volatility increased to levels last seen since the global financial crisis. Now, both consumer and small business sentiment remains at high levels, but the current market uncertainty will put considerable pressure as the virus continues to spread. Now, the University of Michigan's Consumer Sentiment Survey will offer a more up-to-date view of sentiment as it covers data from the end of Feb to the first week of March, which means it includes the recent market as well as the recent virus concerns as well. Now, it's safe to assume that the Fed will be paying very close attention to these metrics as they contemplate their next rate decision for that March 18 meeting. And we also have February CPI numbers due on Wednesday. Now, inflation metrics are important for the Fed based on those dovish or bearish comments we had out of the last FOMC meeting regarding inflation. However, back-looking hard data like CPI should be less important than the forward-looking sentiment indicators that we have coming up. Now, apart from the data, we need to keep careful track of the equity as well as the bond markets. A continuation or reversal in recent equity and bond market moves will also be an important consideration for the US dollar this upcoming week. Now, looking at some possible sentiment shifts and starting with dovish sentiment shifts, some market analysts have cited the stark similarities with the way equity markets have been moving compared to the global financial crisis back in 2008. Now, they've explained that during 2008 and 2009, something like the Dow Jones Index had 11 sessions where the index showed big gains of over 4%. Thus, the big gain that we saw on Wednesday of over 4 and 5% on most major indexes, which basically was followed by a further move to the downside, doesn't really bode well for equity markets, as these big spikes do tend to happen more in bear markets compared to bull markets for equities. Now, with the VIX trading at levels last seen since the global financial crisis, yet another sobering example of the type of risk-off environment that is currently gripping the markets. Now, we know that one of the main reasons the market is pricing in more additional rate cuts for the Fed is due to that quick and aggressive sell-off that we've seen in equity markets. Thus, if we see a continuation of the recent downward momentum, that should nudge the market into expecting even more additional easing from the Fed and could see some more additional downside for the dollar as well. Now, we also need to pay attention to US yields, which are currently trading at record low levels. As long as US bond yields drift lower, that should keep the dollar pressured as well, as it will cause markets to price in more additional rate cuts and increase the probability of the Fed having to restart another QE program. Now, as the coronavirus is the main reason for the market's current fear, any further massive escalation in cases in the US particularly should keep equity markets in the US pressured and should see the market expect more central bank easing and keep the dollar pressured as well. Now, we do also need to pay attention to the sentiment-based indicators, like we said, the NFIB Small Business as well as the University of Michigan sentiment. If we do see a major drop in both of those, that won't really bode well in terms of consumer confidence and spending, as that relates back to economic growth, and could also see some potential pressure on the dollar. Now, a big fall in CPI numbers should give us the biggest reaction from that CPI event this week, given the already bearish tone and sentiment on the dollar. However, most of the focus should fall in terms of economic data, should fall on the sentiment-based indicators. And then also we have the ECB taking the stage later the week as well with their most recent rate decision. Now, if the ECB decides to come across more hawkish than the markets are expecting and basically refrain to take any considerable easing action, that could also see further upside for the euro and could lead to some further downside for the US dollar as well, as that would mean that the dollar is losing even more of that very attractive yield differential between the euro. Then looking at some potential hawkish sentiment shifts, at this stage the balance of positive and negative factors are definitely skewed to the downside for the dollar. However, as the main reason for the recent bearish bias is due to the coronavirus, any significant de-escalation or containment of the virus in the US particularly should have upside potential for the dollar. Possible hawkish sentiment shift would come from a breakthrough to stop either the flow of the virus, such as a confirmed vaccine that drastically decreases the chances of new virus cases, or even a breakthrough in treatment that significantly drops the odds of fatalities. Now, the considerable move lower in the dollar was also driven by the fact that the market has aggressively priced in additional rate cuts from the Fed. Thus, if we see any sizable recovery in equity markets as well as bond markets, and upside in the US bond yields more particularly, that will offer some great short-term support for the dollar as well. Now, if we see the small business and consumer sentiment reports show little signs of deterioration, that could also provide some short-term upside for the dollar as well. But any positive prints in the data should be less in focus this week, like the ISM and NFP data that we had last week, if the overall market sentiment remains sour due to the further escalations on the virus. Now, we also need to pay attention to Europe. So far, the euro has gained considerable ground on the dollar on the back of the market's rate cut expectations for the Fed. And if the ECB surprises markets this week by taking excessive steps to ease monetary policy by cutting rates, let's say by 20 basis points or more, and also increasing their asset purchases program significantly, that can see some relief for the dollar in the short term as well. Then how we can look to trade the dollar. If we do see further dovish developments for the dollar, we can look to pair the dollar against something like the yen or the Swiss franc, which remains favorites in this current risk-off environment due to their safe haven status. And alternatively, if we see a hawkish development for the dollar, we can look to pair the dollar against something like the Canadian dollar, which has been pressured quite a lot in this last week, with the BOC also cutting rates by 50 basis points and also signaling that the bank will not hesitate to cut further if the situation requires them to. Another challenge for the CAD, of course, is oil prices hitting very low levels as global oil demand tanks across the board and OPEC Plus failing to achieve an agreement for an additional production cut in their meetings last week. Guys, remember that these recommendations are based on the current fundamental bias for these currencies at the time of making this video and can change throughout the week. So do make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades.